Hi, I'm Rob Sluymer, the technical strategist at Fundstrat Global Advisors. This video is the first in a series of upcoming videos intended to help investors new to technical analysis understand how it can be helpful in their investment process. In this first video, I discuss a few general concepts about technical analysis and why I think it's an important tool. And in future videos, I'll review the common sense technical tools that I think are important that can help investors better navigate markets and manage risk. What is technical analysis? It's simply the study of how the price of a security or a market is behaving. And the goal of technical analysis is to profit from trending markets and to manage risk as those trends change direction over time. The first record of technical analysis was in Japan in 1700 by a rice merchant who tracked the open, the high, the low, and the closing prices of rice. He's actually considered the father of candlestick charting. In 1710, a futures market emerged for rice. And by 1755, he had written a book which is actually considered the first book on market psychology. He noted that the psychological aspect of the market is critical to trading success, and when all are bearish, there is a cause for prices to rise. So he was one of the first to articulate that markets bottom when everybody is bearish and there are no more sellers left. It's one of the cornerstones of technical analysis in terms of identifying extremes or turning points. So this is a chart of the S&P's price history going back to 1945 up to 2020, with the recession marked in red bars. So one of the important reasons to use technical analysis is that it's an easy way to provide perspective and to understand where a market's longer-term trend is, whether it's up or whether it's sideways or down, so that we can invest knowing whether we have the wind at our back or not. In other words, we want to use technical analysis to identify what the longer-term secular trend is, and then work our way down to shorter time frames, such as quarters or months, and for traders, even weeks and days. Secondly, technical analysis helps identify change in the market, often before the reason for that change is fully understood. Paying attention to changes in a market's trend is a simple and easy way to be alerted that something is beginning to change. Notice how the market peaks far in advance of the red recession bands, and many times there is no recession. So studying the change in an underlying market can be very important to your financial health. Technical analysis has a number of tools to help identify when a market or a security has moved to an extreme in one direction, often referred to as being overbought when it's rallied too far on the upside, and oversold when it's moved too far on the downside. Technical indicators can be particularly helpful signaling those turning points. So prices change for many reasons. There's new information coming into the market. It could be company-specific, where fundamental analysts focus all their attention on. And then there's an endless tsunami of macroeconomic information being reported. And there's all the systematic risks that can shock the markets at any time, all of which investors are trying to digest. So that affects investor sentiment, which in turn affects the change in risk appetite. And that changes the demand and supply, who's willing to buy or sell. And that obviously affects changes in price, which again comes back as new information in the market and the circle continues. So as investors, you can try to master all of the micro and macro or systematic changes taking place, or you can simply analyze how price is reacting to all that information. I'm obviously oversimplifying the process, but hopefully you see that the value and importance of studying how prices are behaving, because ultimately that's all that matters in the end. Technical analysis doesn't have to be complicated, despite some of the complex charts you've seen elsewhere. It's actually a very simple and easy tool to use that can really empower an individual investor to track how the market's changing, how to profit from it, and how to protect capital. So what do we think is important? It really comes down to these 4 points. First, is price trend changing? Secondly, can we find indicators that help us identify turning points in the market? Third, are there tools to help us identify shifts in leadership? And fourth, are there any clues that might lead market turns, areas within or between markets that start to act differently around major market turns? We see this happen regularly at market bottoms and tops. So to me, divergences is one of the most important reasons to study technical analysis, as it alerts us to change beginning to develop within the market. In future videos, I'll discuss each one of these in more detail. So how do you build a technical toolkit with all the thousands of technical indicators out there? I'll finish up this introduction with a very common sense approach to thinking about technical tools. From the thousands of indicators, I'd recommend selecting tools that address the question that investors are trading and traders are always facing. Are markets or sectors at a turning point? And if so, is there a shift in leadership? So we'd use two really common sense tools: momentum indicators to help identify turning points or extremes in the market, and relative performance to identify shifts in leadership. To finish this video, I'd like to discuss two examples of how trend analysis, relative performance, and momentum indicators can be applied to a stock and to a stock market to identify and profit from major trend shifts. On applied materials price, we can add very simple trend lines, and those will help us signal change. That's where the arrows are. That's where the trends have reversed. And we can do the same on the relative performance of applied materials versus the S&P 500. We can identify the downtrends and the uptrends, and we can add arrows there to indicate when those trends are changing. So applying these trend lines is a very good example of how simple and profitable technical analysis can be. Now in this chart, it's a chart of the S&P from 1997 to 2010. I've added a very simple monthly momentum indicator in the bottom panel. It's really just a big rate of change indicator that helps identify extremes. And it's very helpful for identifying when the market is approaching a turning point. Again, I'll discuss a lot of these indicators more in the future, but just as an example, notice that when we got to the 2002-2003 lows, that momentum indicator became oversold and began to bottom. And conversely, when it got to the highs in 2007 and 2008, that momentum indicator began to peak. And once again, as we got to the 2009 lows, that indicator began to bottom. So those major trend shifts that developed in the market between 2000 and 2010, these long-term momentum indicators were pretty helpful to spot those changes. So I'll discuss these indicators more in future videos, but hopefully that's been a useful overview of why we'd encourage you to incorporate technical research into your investment process. So please stay tuned here at FS Insight. I'll be posting more technical analysis videos here, and thank you for taking the time to watch this video.